When you accept the end of history illusion, you realize that the odds of picking a job when you're not old enough to drink, that you will still enjoy when you're old enough to qualify for Social Security, are low. The trick is to accept the reality of change and move on as soon as possible. Jason Zweig, the Wall Street Journal investment columnist, worked with psychologist Daniel Kahneman on writing Kahneman's book, Thinking Fast and Slow. Zweig once told a story about a personality quirk of Kahneman's that served him well. Nothing amazed me more about Danny than his ability to detonate what we had just done, Zweig wrote. He and Kahneman could work endlessly on a chapter, but the next thing you know, Kahneman sends a version so utterly transformed that it is unrecognizable. It begins differently. It ends differently. It incorporates anecdotes and evidence you never would have thought of. It draws on research that you've never heard of. When I asked Danny how he could start again, as if we had never written an earlier draft, so I continued, he said the words I've never forgotten. I have no sunk costs. Sunk costs, anchoring decisions to past efforts that can't be refunded, are a devil in a world where people change over time. They make our future selves prisoners to our past, different selves. It's the equivalent of a stranger making major life decisions for you. Embracing the idea that financial goals made when you were a different person should be abandoned without mercy versus put on life support and dragged on can be a good strategy to minimize future regret. The quicker it's done, everything has a price, and the key to a lot of things with money is just figuring out what that price is and being willing to pay it. The problem is that the price of a lot of things is not obvious until you've experienced them firsthand when the bill is overdue. General Electric was the largest company in the world in 2004, worth $1/3 trillion. It had either been first or second each year for the previous decade, capitalism's shining example of corporate aristocracy. Then everything fell to pieces. The 2008 financial crisis sent GE's financing division, which supplied more than half the company's profits, into chaos. It was eventually sold for scrap. Subsequent bets in oil and energy were disasters, resulting in billions in write-offs. GE stock fell from $40 in 2007 to $7 by 2018. Blame placed on CEO Jeff Immelt, who ran the company since 2001, was immediate and harsh. He was criticized for his leadership, his acquisitions, cutting the dividend, laying off workers, and of course, the plunging stock price. Rightly so. Those rewarded with dynastic wealth when times are good hold the burden of responsibility when the tide goes out. He stepped down in 2017. But Immelt said something insightful on his way out. Responding to critics who said his actions were wrong and what he should have done was obvious, Immelt told his successor, "Every job looks easy when you're not the one doing it because the challenges faced by someone in the arena are often invisible to those in the crowd. Dealing with the conflicting demands of sprawling bloat, short-term investors, regulators, unions, and entrenched bureaucracy is not only hard to do, but it's hard to even recognize the severity of the problems until you're the one dealing with them." Immelt's successor, who lasted 14 months, learned this as well. Most things are harder in practice than they are in theory. Sometimes this is because we're overconfident. More often, it's because we're not good at identifying what the price of success is, which prevents us from being able to pay it. The S&P 500 increased 119-fold in the 50 years ending 2018. All you had to do was sit back and let your money compound. But of course, successful investing looks easy when you're not the one doing it. Hold stocks for the long run, you'll hear. It's good advice. But do you know how hard it is to maintain a long-term outlook when stocks are collapsing? Like everything else worthwhile, successful investing demands a price. But its currency is not dollars and cents. It's volatility, fear, doubt, uncertainty, and regret, all of which are easy to overlook until you're dealing with them in real time. The inability to recognize that investing has a price can tempt us to try to get something for nothing, which, like shoplifting, rarely ends well. Say you want a new car. It costs $30,000. You have three options. 1, pay $30,000 for it. 2, find a cheaper used one. Or 3, steal it. In this case, 99% of people know to avoid the third option because the consequences of stealing a car outweigh the upside. But say you want to earn an 11% annual return over the next 30 years so you can retire in peace. Does this reward come free? Of course not. The world is never that nice. There's a price tag, a bill that must be paid. In this case, it's a never-ending taunt from the market, which gives big returns and takes them away just as fast. Including dividends, the Dow Jones Industrial Average returned about 11% per year from 1950 to 2019, which is great. But the price of success during this period was dreadfully high. For most of that time, the Dow Jones Industrial Average was at least 5% below its previous all-time high. This is the price of market returns, the fee. It is the cost of admission, and it hurts. Like most products, the bigger the returns, the higher the price. Netflix stock returned more than 35,000% from 2002 to 2018, but traded below its previous all-time high on 94% of days. Monster Beverage returned 319,000% from 1995 to 2018, among the biggest returns in history, but traded below its previous high 95% of the time during that period. Now here's the important part. Like the car, you have a few options. You can pay this price, accepting volatility and upheaval, or you can find an asset with less uncertainty and a lower payoff, the equivalent of a used car. Or you can attempt the equivalent of Grand Theft Auto. Try to get the return while avoiding the volatility that comes along with it. Many people in investing choose the third option. Like a car thief, though well-meaning and law-abiding, they form tricks and strategies to get the return without paying the price. They trade in and out. They attempt to sell before the next recession and buy before the next boom. Most investors with even a little experience know that volatility is real and common. Many then take what seems like the next logical step, trying to avoid it. But the money gods do not look highly upon those who seek a reward without paying the price. Some car thieves will get away with it. Many more will get caught and punished. Same thing with investing. Morningstar once looked at the performance of tactical mutual funds, whose strategy is to switch between stocks and bonds at opportune times, capturing market returns with lower downside risk. They want the returns without paying the price. The study focused on the mid-2010 through late 2011 period when U.S. stock markets went wild on fears of a new recession, and the S&P 500 declined by more than 20%. This is the exact kind of environment the tactical funds are supposed to work in. It was their moment to shine. There were, by Morningstar's count, 112 tactical mutual funds during this period. Only 9 had better risk-adjusted returns than a simple 60-40 stock-bond fund. Less than a quarter of the tactical funds had smaller maximum drawdowns than the Leave-It-Alone index. Morningstar wrote, with a few exceptions, tactical funds gained less, were more volatile, or were subject to just as much downside risk as the hands-off fund. Individual investors fall for this when making their own investments too. The average equity fund investor underperformed the funds they invested in by 0.5% per year, according to Morningstar, the result of buying and selling when they should have just bought and held. The irony is that by trying to avoid the price, investors end up paying double. Back to GE. One of its many faults stems from an era under former CEO Jack Welch. Welch became famous for ensuring quarterly earnings per share beat Wall Street estimates. He was the grandmaster. If Wall Street analysts expected 25 cents per share, Jack would deliver 26 cents, no matter the state of the business or the economy. He'd do that by massaging the numbers. That description is charitable, often pulling gains from future quarters into the current quarter to make the obedient numbers salute their master. Forbes reported one of dozens of examples. General Electric, for 2 years in a row, sold locomotives to unnamed financial partners instead of end users in transactions that left most of the risks of ownership with GE. Welch never denied this game. He wrote in his book, Straight from the Gut, "The response of our business leaders to the crisis was typical of the GE culture. Even though the books had closed on the quarter, many immediately offered to pitch in and cover the earnings gap. Some said they could find an extra $10 million, $20 million, and even $30 million from their business to offset the surprise." The result was that under Welch's leadership, stockholders didn't have to pay the price. They got consistency and predictability, a stock that surged year after year without the surprises of uncertainty. Then the bill came due, like it always does. GE shareholders have suffered through a decade of mammoth losses that were previously shielded by accounting maneuvers. The penny gains of Welch's era became dime losses today. The strangest example of this comes from failed mortgage giants Freddie Mac and Fannie Mae, which in the early 2000s were caught underreporting current earnings by billions of dollars, with the intention of spreading those gains out over future periods to give investors the illusion of smoothness and predictability, the illusion of not having to pay the price. The question is, why do so many people who are willing to pay the price of cars, houses, food, and vacations try so hard to avoid paying the price of good investment returns? The answer is simple. The price of investing success is not immediately obvious. It's not a price tag you can see. So when the bill comes due, it doesn't feel like a fee for getting something good. It feels like a fine for doing something wrong. And while people are generally fine with paying fees, fines are supposed to be avoided. You're supposed to make decisions that preempt and avoid fines. Traffic fines and IRS fines mean you did something wrong and deserve to be punished. The natural response for anyone who watches their wealth decline and views that drop as a fine is to avoid future fines. It sounds trivial, but thinking of market volatility as a fee rather than a fine is an important part of developing the kind of mindset that lets you stick around long enough for investing gains to work in your favor. Few investors have the disposition to say, "I'm actually fine if I lose 20% of my money." This is doubly true for new investors who have never experienced a 20% decline. But if you view volatility as a fee, things look different. Disneyland tickets cost $100, but you get an awesome day with your kids you'll never forget. Last year, more than 18 million people thought that fee was worth paying. Few felt the $100 was a punishment or a fine. The worthwhile trade-off of fees is obvious when it's clear you're paying one. Same with investing, where volatility is almost always a fee, not a fine. Market returns are never free and never will be. They demand you pay a price. Like any other product, you're not forced to pay this fee, just like you're not forced to go to Disneyland. You can go to the local county fair where tickets might be $10 or stay home for free. You might still have a good time, but you'll usually get what you pay for. Same with markets. The volatility uncertainty fee, the price of returns, is the cost of admission to get returns greater than low-fee parks like cash and bonds. The trick is convincing yourself that the market's fee is worth it. That's the only way to properly deal with volatility and uncertainty, not just putting up with it, but realizing that it's an admission fee worth paying. There's no guarantee that it will be. Sometimes it rains at Disneyland, but if you view the admission fee as a fine, you'll never enjoy the magic. Find the price, then pay it. Chapter 16, You and Me. The implosion of the dot-com bubble in the early 2000s reduced household wealth by $6.2 trillion. The end of the housing bubble cut away more than $8 trillion. It's hard to overstate how socially devastating financial bubbles can be. They ruin lives, Why do these things happen? And why do they keep happening? Why can't we learn our lessons? The common answer here is that people are greedy, and greed is an indelible feature of human nature. That may be true, and it's a good enough answer for most, but remember from chapter 1, no one is crazy. People make financial decisions they regret, and they often do so with scarce information and without logic. But the decisions made sense to them when they were made. Blaming bubbles on greed and stopping there misses important lessons about how and why people rationalize what in hindsight look like greedy decisions. Part of why bubbles are hard to learn from is that they are not like cancer, where a biopsy gives us a clear warning and diagnosis. They are closer to the rise and fall of a political party, where the outcome is known in hindsight, but the cause and blame are never agreed upon. Competition for investment returns is fierce, and someone has to own every asset at every point in time. That means the mere idea of bubbles will always be controversial, because no one wants to think they own an overvalued asset. In hindsight, we're more likely to point cynical fingers than to learn lessons. I don't think we'll ever be able to fully explain why bubbles occur. It's like asking why wars occur. There are almost always several reasons, many of them conflicting, all of them controversial. It's too complicated a subject for simple answers. But let me propose one reason they happen that goes both overlooked and applies to you personally. Investors often innocently take cues from other investors who are playing a different game than they are. An idea exists in finance that seems innocent, but has done incalculable damage. It's the notion that assets have one rational price in a world where investors have different goals and time horizons. Ask yourself, how much should you pay for Google stock today? The answer depends on who you are. Do you have a 30-year time horizon? Then the smart price to pay involves a sober analysis of Google's discounted cash flows over the next 30 years. Are you looking to cash out within 10 years? Then the price to pay can be figured out by an analysis of the tech industry's potential over the next decade and whether Google management can execute on its vision. Are you looking to sell within a year? Then pay attention to Google's current product sales cycles and whether we'll have a bear market. Are you a day trader? Then the smart price to pay is who cares, because you're just trying to squeeze a few bucks out of whatever happens between now and lunchtime, which can be accomplished at any price. When investors have different goals and time horizons, and they do in every asset class, prices that look ridiculous to one person can make sense to another, because the factors those investors pay attention to are different. Take the dot-com bubble in the 1990s. People can look at Yahoo stock in 1999 and say, that was crazy, a zillion times revenue, the valuation made no sense. But many investors who owned Yahoo stock in 1999 had time horizons so short that it made sense for them to pay a ridiculous price. A day trader could accomplish what they need whether Yahoo was at $5 a share or $500 a share, as long as it moved in the right direction that day. And it did, for years. An iron rule of finance is that money chases returns to the greatest extent that it can. If an asset has momentum, it's been moving consistently up for a period of time, it's not crazy for a group of short-term traders to assume it will keep moving up. Not indefinitely, just for the short period of time they need it to. Momentum attracts short-term traders in a reasonable way. Then it's off to the races. Bubbles form when the momentum of short-term returns attracts enough money that the makeup of investors shifts from mostly long-term to mostly short-term. That process feeds on itself. As traders push up short-term returns, they attract even more traders. Before long, and it often doesn't take long, the dominant market price setters with the most authority are those with shorter time horizons. Bubbles aren't so much about valuations rising. That's just a symptom of something else. Time horizons shrinking as more short-term traders enter the playing field. It's common to say the dot-com bubble was a time of irrational optimism about the future. But one of the most common headlines of that era was announcing record trading volume, which is what happens when investors are buying and selling in a single day. Investors, particularly the ones setting prices, were not thinking about the next 20 years. The average mutual fund had 120% annual turnover in 1999, meaning they were, at most, thinking about the next 8 months. So were the individual investors who bought those mutual funds. Maggie Mahar wrote in her book, Bull, by the mid-90s, the press had replaced annual scorecards with reports that appeared every 3 months. The change spurred investors to chase performance, rushing to buy the funds at the top of the charts, just when they were the most expensive. This was the era of day trading, short-term option contracts, and up-to-the-minute market commentary. It's not the kind of thing you'd associate with long-term views. The same thing happened during the housing bubble of the mid-2000s. It's hard to justify paying $700,000 for a 2-bedroom Florida tract home to raise your family in for the next 10 years. But it makes perfect sense if you plan on flipping the home in a few months into a market with rising prices to make a quick profit, which is exactly what many people were doing during the bubble. Data from Atom, a company that tracks real estate transactions, shows the number of houses in America that sold more than once in a 12-month period, they were flipped, rose 5-fold during the bubble, from 20,000 in the first quarter of 2000 to over 100,000 in the first quarter of 2004. Flipping plunged after the bubble to less than 40,000 per quarter, where it's roughly remained since. Do you think these flippers cared about long-term price-to-rent ratios, or whether the prices they paid were backed up by long-term income growth? Of course not. Those numbers weren't relevant to their game. The only thing that mattered to flippers was that the price of the home would be more next month than it was this month. And for many years, it was. You can say a lot about these investors. You can call them speculators. You can call them irresponsible. You can shake your head at their willingness to take huge risks. But I don't think you can call all of them irrational. The formation of bubbles isn't so much about people irrationally participating in long-term investing. They're about people somewhat rationally moving toward short-term trading to capture momentum that had been feeding on itself. What do you expect people to do when momentum creates a big short-term return potential? Sit and watch patiently? Never. That's not how the world works. Profits will always be chased, and short-term traders operate in an area where the rules governing long-term investing, particularly around valuation, are ignored because they're irrelevant to the game being played. That's where things get interesting and where the problems begin. Bubbles do their damage when long-term investors playing one game start taking their cues from those short-term traders playing another. Cisco Systems stock rose 300% in 1999 to $60 a share. At that price, the company was valued at $600 billion, which is insane. Few actually thought it was worth that much. The day traders were just having their fun. Economist Burton Malkiel once pointed out that Cisco's implied growth rate at that valuation meant it would become larger than the entire U.S. economy within 20 years. But if you were a long-term investor in 1999, $60 was the only price available to buy. And many people were buying it at that price. So you may have looked around and said to yourself, wow, maybe these other investors know something I don't. Maybe you went along with it. You even felt smart about it. What you don't realize is that the traders who were setting the marginal price of the stock were playing a different game than you were. $60 a share was a reasonable price for the traders because they planned on selling the stock before the end of the day, when the price would probably be higher. But $60 was a disaster in the making for you because you planned on holding shares for the long run. These two investors rarely even know that each other exist, but they're on the same field running toward each other. When their paths blindly collide, someone gets hurt. Many finance and investment decisions are rooted in watching what other people do and either copying them or betting against them. But when you don't know why someone behaves like they do, you won't know how long they'll continue acting that way. what will make them change their mind or whether they'll ever learn their lesson. When a commentator on CNBC says, "You should buy this stock," keep in mind that they do not know who you are. Are you a teenager trading for fun? An elderly widow on a limited budget? A hedge fund manager trying to shore up your books before the quarter ends? Are we supposed to think those three people have the same priorities and that whatever level a particular stock is trading at is right for all three of them? It's crazy. It's hard to grasp that other investors have different goals than we do, because an anchor of psychology is not realizing that rational people can see the world through a different lens than your own. Rising prices persuade all investors in ways the best marketers envy. They are a drug that can turn value-conscious investors into dewy-eyed optimists, detached from their own reality by the actions of someone playing a different game than they are. Being swayed by people playing a different game can also throw off how you think you're supposed to spend your money. So much consumer spending, particularly in developed countries, is socially driven, subtly influenced by people you admire, and done because you subtly want people to admire you. And while we can see how much money other people spend on cars, homes, clothes, and vacations, we don't get to see their goals, worries, and aspirations. A young lawyer aiming to be a partner at a prestigious law firm might need to maintain an appearance that I, a writer who can work in sweatpants, have no need for. But when his purchases set my own expectations, I'm wandering down a path of potential disappointment because I'm spending the money without the career boost he's getting. We might not even have different styles. We're just playing a different game. It took me years to figure this out. A takeaway here is that few things matter more with money than understanding your own time horizon and not being persuaded by the actions and behaviors of people playing different games than you are. The main thing I can recommend is going out of your way to identify what game you're playing. It's surprising how few of us do. We call everyone investing money investors, like they're basketball players, all playing the same game with the same rules. When you realize how wrong that notion is, you see how vital it is to simply identify what game you're playing. How I invest my own money is detailed in Chapter 20. But years ago, I wrote out, "I'm a passive investor optimistic in the world's ability to generate real economic growth, and I'm confident that over the next 30 years, that growth will accrue to my investments." This might seem quaint, but once you write that mission statement down, you realize everything that's unrelated to it, what the market did this year, or whether we'll have a recession next year, is part of a game I'm not playing. So I don't pay attention to it, and am in no danger of being persuaded by it. Next, let's talk about pessimism. Chapter 17, The Seduction of Pessimism. Optimism is the best bet for most people because the world tends to get better for most people most of the time. But pessimism holds a special place in our hearts. Pessimism isn't just more common than optimism. It also sounds smarter. It's intellectually captivating, and it's paid more attention than optimism, which is often viewed as being oblivious to risk. Before we go further, we should define what optimism is. Real optimists don't believe that everything will be great. That's complacency. Optimism is a belief that the odds of a good outcome are in your favor over time, even when there will be setbacks along the way. The simple idea that most people wake up in the morning trying to make things a little better and more productive than wake up looking to cause trouble is the foundation of optimism. It's not complicated. It's not guaranteed either. It's just the most reasonable bet for most people most of the time. The late statistician Hans Rosling put it differently. I am not an optimist. I am a very serious possibilist. Now we can discuss optimism's more compelling sibling, pessimism. December 29th, 2008. The worst year for the economy in modern history is about to close. Stock markets around the world had collapsed. The global financial system was on day-to-day life support. Unemployment was surging. As things looked like they couldn't get worse, the Wall Street Journal published a story arguing that we hadn't seen anything yet. It ran a front-page article on the outlook of a Russian professor named Igor Panarin, whose economic views rival the flair of science fiction writers. The journal wrote, around the end of June 2010 or early July, Panarin says the U.S. will break into 6 pieces, with Alaska reverting to Russian control. California will form the nucleus of what he calls the Californian Republic and will be part of China or under Chinese influence. Texas will be the heart of the Texas Republic, a cluster of states that will go to Mexico or fall under Mexican influence. Washington, D.C. and New York will be part of an Atlantic America that may join the European Union. Canada will grab a group of northern states Professor Panarin calls the Central North American Republic. Hawaii, he suggests, will be a protectorate of Japan or China, and Alaska will be subsumed into Russia. This was not the ramblings of a backroom blog or tinfoil hat newsletter. This was on the front page of the most prestigious financial newspaper in the world. It is fine to be pessimistic about the economy. It's even okay to be apocalyptic. History is full of examples of countries experiencing not just recessions, but disintegrations. The interesting thing about Panarin-type stories is that their polar opposite, forecasts of outrageous optimism, are rarely taken as serious as prophets of doom. Take Japan in the late 1940s. The nation was gutted by defeat from World War II in every way, economically, industrially, culturally, socially. A brutal winter in 1946 caused a famine that limited food to less than 800 calories per person per day. Imagine if a Japanese academic had written a newspaper article during this time that said, "Chin up, everyone. Within our lifetime, our economy will grow to almost 15 times the size it was before the end of the war. Our life expectancy will nearly double. Our stock market will produce returns like any country in history has rarely seen. We will go more than 40 years without ever seeing unemployment top 6%. We will become a world leader in electronic innovation and corporate managerial systems. Before long, we will be so rich that we will own some of the most prized real estate in the United States. Americans, by the way, will be our closest ally and will try to copy our economic insights." They would have been summarily laughed out of the room and asked to seek a medical evaluation. Keep in mind, the description you just heard is what actually happened in Japan in the generation after the war. But the mirror opposite of Panarin looks absurd in a way a forecast of doom doesn't. Pessimism just sounds smarter and more plausible than optimism. Tell someone that everything will be great, and they're likely to either shrug you off or offer a skeptical eye. Tell someone they're in danger, and you have their undivided attention. If a smart person tells me they have a stock pick that's going to rise tenfold in the next year, I will immediately write them off as full of nonsense. If someone who's full of nonsense tells me that a stock I own is about to collapse because it's an accounting fraud, I will clear my calendar and listen to their every word. Say we'll have a big recession and newspapers will call you. Say we're headed for average growth and no one particularly cares. Say we're nearing the next Great Depression and you'll get on TV. But mention that good times are ahead, or markets have room to run, or that a company has huge potential, and a common reaction from commentators and spectators alike is that you are either a salesman or comically aloof of risks. The investing newsletter industry has known this for years and is now populated by prophets of doom, despite operating in an environment where the stock market has gone up 17,000-fold in the last century, including dividends. This is true beyond finance. Matt Ridley wrote in his book, The Rational Optimist, "A constant drumbeat of pessimism usually drowns out any triumphalist song. If you say the world has been getting better, you may get away with being called naive and insensitive. If you say the world is going to go on getting better, you are considered embarrassingly mad. If, on the other hand, you say catastrophe is imminent, you may expect a MacArthur Genius Award or even the Nobel Peace Prize. In my own adult lifetime, the fashionable reasons for pessimism changed, but the pessimism was constant. Every group of people I ask thinks the world is more frightening, more violent, and more hopeless, in short, more dramatic than it really is, Hans Rosling wrote in his book, Factfulness. When you realize how much progress humans can make during a lifetime, in everything from economic growth to medical breakthroughs to stock market gains to social equality, you would think optimism would gain more attention than pessimism. And yet, the intellectual allure of pessimism has been known for ages. John Stuart Mill wrote in the 1840s, "I have observed that not the man who hopes when others despair, but the man who despairs when others hope is admired by a large class of persons as a sage." The question is, why? And how does it impact how we think about money? Let's repeat the premise that no one is crazy. There are valid reasons why pessimism is seductive when dealing with money. It just helps to know what they are to ensure we don't take them too far. Part of it is instinctual and unavoidable. Kahneman says the asymmetric aversion to loss is an evolutionary shield. He writes, when directly compared or weighted against each other, losses loom larger than gains. This asymmetry between the power of positive and negative expectations or experiences has an evolutionary history. Organisms that treat threats as more urgent than opportunities have a better chance to survive and reproduce. But a few other things make financial pessimism easy, common, and more persuasive than optimism. One is that money is ubiquitous, so something bad happening tends to affect everyone and captures everyone's attention. This isn't true of, say, weather. A hurricane barreling down on Florida poses no direct risk to 92% of Americans, but a recession barreling down on the economy could impact every single person, including you, so pay attention. This goes for something as specific as the stock market. More than half of all American households directly own stocks. Even among those that don't, the stock market's gyrations are promoted so heavily in the media that the Dow Jones Industrial Average might be the stockless household's most watched economic barometer. Stocks rising 1% might be briefly mentioned in the evening news, but a 1% fall will be reported in bold, all-caps letters, usually written in blood red. The asymmetry is hard to avoid. And while few question or try to explain why the market went up, isn't it supposed to go up? There is almost always an attempt to explain why it went down. Are investors worried about economic growth? Did the Fed screw things up again? Are politicians making bad decisions? Is there another shoe to drop? Narratives about why a decline occurred make them easier to talk about, worry about, and frame a story around what you think will happen next. Usually more of the same. Even if you don't own stocks, those kind of things will grab your attention. Only 2.5% of Americans own stocks on the eve of the great crash of 1929 that sparked the Great Depression. But the majority of Americans, if not the world, watched in amazement as the market collapsed, wondering what it signaled about their own fate. This was true whether you were a lawyer or a farmer or a car mechanic. Historian Eric Rauschway writes, "This fall in value immediately afflicted only a few Americans. But so closely had the others watched the market and regarded it as an index of their fates that they suddenly stopped much of their economic activity. As the economist Joseph Schumpeter later wrote, people felt that the ground under their feet was giving way." There are two topics that will affect your life, whether you are interested in them or not: money and health. While health issues tend to be individual, money issues are more systemic. In a connected system where one person's decisions can affect everyone else, it's understandable why financial risks gain a spotlight and capture attention in a way few other topics can. Another is that pessimists often extrapolate present trends without accounting for how markets adapt. In 2008, environmentalist Lester Brown wrote, "By 2030, China would need 98 million barrels of oil a day. The world is currently producing 85 million barrels a day and may never produce much more than that. There go the world's oil reserves." He's right. The world would run out of oil in that scenario. But that's not how markets work. There is an iron law in economics. Extremely good and extremely bad circumstances rarely stay that way for long because supply and demand adapt in hard-to-predict ways. Consider what happened to oil immediately after Brown's prediction. Oil prices surged in 2008 as growing global demand, much of it from China, crept up to potential output. A barrel of oil sold for $20 in 2001 and $138 by 2008. The new price meant drilling oil was like pulling gold out of the ground. The incentives for oil producers changed dramatically. Hard-to-tap oil supplies that weren't worth the fight at $20 a barrel, the cost of drilling didn't offset the price you could sell it for, became the bonanza of a lifetime now that you could sell a barrel for $138. That sparked a surge of new fracking and horizontal drilling technologies. The Earth has had roughly the same amount of oil reserves for all of human history, and we've known where the big oil deposits are for some time. What changes is the technology we have that lets us economically pull the stuff out of the ground. Oil historian Daniel Yergin writes, 86% of oil reserves in the United States are the result not of what is estimated at time of discovery, but of the revisions that come when our technology improves. That's what happened as fracking took off in 2008. In the United States alone, oil production went from roughly 5 million barrels per day in 2008 to 13 million by 2019. World oil production is now over 100 million barrels per day, some 20% above what Brown assumed was the high mark. To a pessimist extrapolating oil trends in 2008, of course things looked bad. To a realist who understood that necessity is the mother of all invention, it was far less scary. Assuming that something ugly will stay ugly is an easy forecast to make, and it's persuasive because it doesn't require imagining the world changing. But problems correct, and people adapt. Threats incentivize solutions in equal magnitude. That's a common plot of economic history that is too easily forgotten by pessimists who forecast in straight lines. A third is that progress happens too slowly to notice, but setbacks happen too quickly to ignore. There are lots of overnight tragedies. There are rarely overnight miracles. On June 5th, 1889, the Detroit Free Press pushed back against the long-held dream that man could one day fly like a bird. Airplanes, the paper wrote, appear impossible. The smallest possible weight of a flying machine, with the necessary fuel and engineer, could not be less than 300 or 400 pounds. But there is a low limit of weight, certainly not much beyond 50 pounds, beyond which it is impossible for an animal to fly. Nature has reached this limit, and with her utmost effort has failed to pass it. 6 months later, Orville Wright dropped out of high school to help his brother Wilbur tinker in their backyard shed to build a printing press. It was the brothers' first joint invention. It would not be their last. If you had to make a list of the most important inventions of the 20th century, the airplane would be at least top 5, if not number 1. The airplane changed everything. It started world wars. It ended world wars. It connected the world, bridging gaps between cities and rural communities, oceans and countries. But the story of the Wright brothers' quest to build the first plane has a fascinating twist. After they conquered flight, no one seemed to notice. Nobody seemed to care. In his 1952 book on American history, Frederick Lewis Allen wrote, "Several years went by before the public grasped what the Wrights were doing. People were so convinced that flying was impossible that most of those who saw them flying about Dayton, Ohio in 1905 decided that what they had seen must be some trick without significance, somewhat as most people today would regard a demonstration of, say, telepathy. It was not until May 1908, nearly 4.5 years after the Wrights' first flight, that experienced reporters were sent to observe what they were doing. Experienced editors gave full credence to these reporters' excited dispatches, and the world at last woke up to the fact that human flight had been successfully accomplished. Even after people caught on to the plane's wonder, they underestimated it for years. First, it was seen mainly as a military weapon, then a rich person's toy, then perhaps used to transport a few people. The Washington Post wrote in 1909, "There will never be such a thing as commercial aerial freighters. Freight will continue to drag its slow weight across the patient earth." The first cargo plane took off 5 months later. Now compare that slow, years-long awakening to becoming optimistic about the airplane to how quickly people pay attention to drivers of pessimism, like a corporate bankruptcy, or a major war, or a plane crash. Some of the first mentions of the Wright's plane came in 1908, when an Army lieutenant named Thomas Selfridge was killed during a demonstration flight. Growth is driven by compounding, which always takes time. Destruction is driven by single points of failure, which can happen in seconds, and loss of confidence, which can happen in an instant. It's easier to create a narrative around pessimism because the story pieces tend to be fresher and more recent. Optimistic narratives require looking at a long stretch of history and developments, which people tend to forget and take more effort to piece together. Consider the progress of medicine. Looking at the last year will do you little good. Any single decade won't do much better. But looking at the last 50 years will show something extraordinary. For example, the age-adjusted death rate per capita from heart disease has declined more than 70% since 1965, according to the National Institute of Health. A 70% decline in heart disease death is enough to save something like 500,000 American lives per year. Picture the population of Atlanta saved every year. But since that progress happens so slowly, it captures less attention than quick sudden losses like terrorism, plane crashes, or natural disasters. We could have a Hurricane Katrina 5 times a week, every week. Imagine how much attention that would receive. And it would not offset the number of annual lives saved by the decline in heart disease in the last 50 years. The same thing applies to business, where it takes years to realize how important a product or company is, but failures can happen overnight. And in stock markets, where a 40% decline that takes place in 6 months will draw congressional investigations, but a 140% gain that takes place over 6 years can go virtually unnoticed. And in careers, where reputations take a lifetime to build and a single email to destroy, the short staying of pessimism prevails while the powerful pull of optimism goes unnoticed. This underscores an important point made previously in this book. In investing, you must identify the price of success, volatility and loss amid the long backdrop of growth, and be willing to pay it. In 2004, the New York Times interviewed Stephen Hawking, the scientist whose incurable motor neuron disease left him paralyzed and unable to talk at age 21. Through his computer, Hawking told the interviewer how excited he was to sell books to lay people. "Are you always this cheerful?" the Times asked. "My expectations were reduced to 0 when I was 21. Everything since then has been a bonus," he replied. Expecting things to be great means a best-case scenario that feels flat. Pessimism reduces expectations, narrowing the gap between possible outcomes and outcomes you feel great about. Maybe that's why it's so seductive. Expecting things to be bad is the best way to be pleasantly surprised when they're not, which ironically is something to be optimistic about. Now, a short story about stories. Chapter 18, When You'll Believe Anything. Imagine an alien dispatched to Earth. His job is to keep tabs on our economy. He circles above New York City, trying to size up the economy and how it changed between 2007 and 2009. On New Year's Eve 2007, he hovers over Times Square. He sees tens of thousands of happy partygoers surrounded by bright lights, monstrous billboards, fireworks, and TV cameras. He comes back to Times Square on New Year's Eve 2009. He sees tens of thousands of happy partygoers surrounded by bright lights, monstrous billboards, fireworks, and TV cameras. It looks about the same. He cannot see much difference. He sees roughly the same number of New Yorkers hustling around the city. Those people are surrounded by the same number of office buildings, which house the same number of desks, with the same number of computers hooked up to the same number of internet connections. Outside the city, he sees the same number of factories and warehouses, connected by the same highways, carrying the same number of trucks. He gets a little closer to the ground and sees the same universities teaching the same topics and handing out the same degrees to the same number of people. He sees the same number of patents protecting the same groundbreaking ideas. He notices the technology has improved. Everyone in 2009 carries smartphones that didn't exist in 2007. Computers are now faster, medicine is better, cars get better gas mileage, solar and fracking technology has advanced, social media has grown exponentially. As he flies around the country, he sees the same. Around the globe, more of the same. The economy is in about the same shape, maybe even better in 2009 as it was in 2007, he concludes. Then he looks at the numbers. He's shocked that U.S. households are $16 trillion poorer in 2009 than they were in 2007. He's dumbfounded that 10 million more Americans are unemployed. He's in disbelief when he learns the stock market is worth half of what it was 2 years before. He can't believe that people's forecast of their economic potential has plunged. I don't get it, he says. I've seen the cities. I've looked at the factories. You guys have the same knowledge, the same tools, the same ideas. Nothing has changed. Why are you poorer? Why are you more pessimistic? There was one change the alien couldn't see between 2007 and 2009. The stories we told ourselves about the economy. In 2007, we told a story about the stability of housing prices, the prudence of bankers, and the ability of financial markets to accurately price risk. In 2009, we stopped believing that story. That's the only thing that changed, but it made all the difference in the world. Once the narrative that home prices will keep rising broke, mortgage defaults rose, then banks lost money, then they reduced lending to other businesses, which led to layoffs, which led to less spending, which led to more layoffs, and on and on. Other than clinging to a new narrative, we had an identical, if not greater, capacity for wealth and growth in 2009 as we did in 2007. Yet the economy suffered its worst hit in 80 years. This is different from, say, Germany in 1945, whose manufacturing base had been obliterated, or Japan in the 2000s, whose working-age population was shrinking. That's tangible economic damage. In 2009, we inflicted narrative damage on ourselves, and it was vicious. It's one of the most potent economic forces that exists. When we think about the growth of economies, businesses, investments, and careers, we tend to think about tangible things. How much stuff do we have, and what are we capable of? But stories are, by far, the most powerful force in the economy. They are the fuel that can let the tangible parts of the economy work, or the brake that holds our capabilities back. At the personal level, there are two things to keep in mind about a story-driven world when managing your money. One, the more you want something to be true, the more likely you are to believe a story that overestimates the odds of it being true. What was the happiest day of your life? The documentary How to Live Forever asks that innocent question to a centenarian who offered an amazing response. Armistice Day, she said, referring to the 1918 agreement that ended World War I. Why, the producer asks. Because we knew there would be no more wars ever again, she says. World War II began 21 years later, killing 75 million people. There are many things in life that we think are true because we desperately want them to be true. I call these things appealing fictions. They have a big impact on how we think about money, particularly investments and the economy. An appealing fiction happens when you are smart, you want to find solutions, but face a combination of limited control and high stakes. They are extremely powerful. They can make you believe just about anything. Take a short example. Ali Hajjaji's son was sick. Elders in his Yemeni village proposed a folk remedy. Shove the tip of a burning stick through his son's chest to drain the sickness from his body. After the procedure, Hijazi told the New York Times, "When you have no money and your son is sick, you'll believe anything." Medicine predates useful medicine by thousands of years. Before the scientific method and discovery of germs, there was bloodletting, starvation therapy, cutting holes in your body to let the evils out, and other treatments that did nothing but hasten your demise. It seems crazy, but if you desperately need a solution and a good one isn't known or readily available to you, the path of least resistance is toward Hijazi's reasoning, willing to believe anything. Not just try anything, but believe it. Chronicling the Great Plague of London, Daniel Defoe wrote in 1722, "The people were more addicted to prophecies and astrological conjurations, dreams, and old wives' tales than ever they were before or since. Almanacs frightened them terribly. The posts of houses and corners of streets were plastered over with doctors' bills and papers of ignorant fellows quacking and inviting the people to come to them for remedies, which was generally set off with such flourishes as these: infallible preventative pills against the plague, never-failing preservatives against the infection, sovereign cordials against the corruption of the air." The plague killed 1/4 of Londoners in 18 months. You'll believe just about anything when the stakes are that high. Now think about how the same set of limited information and high stakes impact our financial decisions. Why do people listen to TV investment commentary that has little track record of success? Partly because the stakes are so high in investing. Get a few stock picks right, and you can become rich without much effort. If there's a 1% chance that someone's prediction will come true, and it coming true will change your life, it's not crazy to pay attention, just in case. And there are so many financial opinions that once you pick a strategy or side, you become invested in them both financially and mentally. If you want a certain stock to rise tenfold, that's your tribe. If you think a certain economic policy will spark hyperinflation, that's your side. These may be low probability bets. The problem is that viewers can't or don't calibrate low odds like a 1% chance. Many default to a firm belief that what they want to be true is unequivocally true. But they're only doing that because the possibility of a huge outcome exists. Investing is one of the only fields that offers daily opportunities for extreme rewards. People believe in financial quackery in a way they never would for, say, weather quackery, because the rewards for correctly predicting what the stock market will do next week are in a different universe than the rewards for predicting whether it will be sunny or rainy next week. Consider that 85% of active mutual funds underperformed their benchmark over the 10 years ending 2018. That figure has been fairly stable for generations. You would think an industry with such poor performance would be a niche service and have a hard time staying in business. But there's almost $5 trillion invested in these funds. Give someone the chance of investing alongside the next Warren Buffett, and they'll believe with such faith that millions of people will put their life savings behind it. Or take Bernie Madoff. In hindsight, his Ponzi scheme should have been obvious. He reported returns that never varied. They were audited by a relatively unknown accounting firm, and he refused to release much information on how the returns were achieved. Yet Madoff raised billions of dollars from some of the most sophisticated investors in the world. He told a good story, and people wanted to believe it. This is a big part of why room for error, flexibility, and financial independence, important themes discussed in previous chapters, are indispensable. The bigger the gap between what you want to be true and what you need to be true to have an acceptable outcome, the more you are protecting yourself from falling victim to an appealing financial fiction. When thinking about room for error in a forecast, it is tempting to think that potential outcomes range from you being just right enough to you being very, very right. But the biggest risk is that you want something to be true so badly that the range of your forecast isn't even in the same ballpark as reality. In its last 2007 meeting, the Federal Reserve predicted what economic growth would be in 2008 and 2009. Already weary of a weakening economy, it was not optimistic. It predicted a range of potential growth: 1.6% growth on the low end, 2.8% on the high end. That was its margin of safety, its room for error. In reality, the economy contracted by more than 2%, meaning the Fed's low-end estimate was off by almost threefold. It's hard for a policymaker to predict an outright recession, because a recession will make their careers complicated. So even worst-case projections rarely expect anything worse than just slowish growth. It's an appealing fiction, and it's easy to believe because expecting anything worse is too painful to consider. Policymakers are easy targets for criticism, but all of us do this to some extent, and we do it in both directions. If you think a recession is coming, and you cash out of your stocks in anticipation, your view of the economy is suddenly going to be warped by what you want to happen. Every blip, every anecdote will look like a sign that doom has arrived, maybe not because it has, but because you want it to. Incentives are a powerful motivator, and we should always remember how they influence our own financial goals and outlooks. It can't be overstated. There is no greater force in finance than room for error, and the higher the stakes, the wider it should be. 2, everyone has an incomplete view of the world, but we form a complete narrative to fill in the gaps. My daughter is about a year old as I write this. She's curious about everything and learns so fast, but sometimes I think about all the stuff she can't comprehend. She has no idea why her dad goes to work every morning. The concept of bills, budgets, careers, promotions, and saving for retirement are completely foreign to her. Imagine trying to explain the Federal Reserve, credit derivatives, or NAFTA to her. Impossible. But her world isn't dark. She does not wander around in confusion. Even at a year old, she's written her own internal narrative of how everything works. Blankets keep you warm, mom's snuggles keep you safe, and dates taste good. Everything she comes across fits into one of a few dozen mental models she's learned. When I go to work, she doesn't stop in confusion, wondering what salary and bills are. She has a crystal clear explanation of the situation. Dad isn't playing with me, and I wanted him to play with me, so I'm sad. Even though she knows little, she doesn't realize it because she tells herself a coherent story about what's going on based on the little she does know. All of us, no matter our age, do the same thing. Just like my daughter, I don't know what I don't know, so I am just as susceptible to explaining the world through the limited set of mental models I have at my disposal. Like her, I look for the most understandable cases in everything I come across. And like her, I'm wrong about a lot of them because I know a lot less about how the world works than I think I do. This is true for the most fact-based of subjects. Take history. It's just the recounting of stuff that already happened. It should be clear and objective. But as B.H. Liddell Hart writes in his book, Why Don't We Learn from History? History cannot be interpreted without the aid of imagination and intuition. The sheer quantity of evidence is so overwhelming that selection is inevitable. Where there is selection, there is art. Those who read history tend to look for what proves them right and confirms their personal opinions. They defend loyalties. They read with a purpose to affirm or to attack. They resist inconvenient truth, since everyone wants to be on the side of the angels, just as we start wars to end all wars. Daniel Kahneman once told me about the stories people tell themselves to make sense of the past. He said, hindsight, the ability to explain the past, gives us the illusion that the world is understandable. It gives us the illusion that the world makes sense even when it doesn't make sense. That's a big deal in producing mistakes in many fields. Most people, when confronted with something they don't understand, do not realize they don't understand it because they're able to come up with an explanation that makes sense based on their own unique perspective and experiences in the world. however limited those experiences are. We all want the complicated world we live in to make sense, so we tell ourselves stories to fill in the gaps of what are effectively blind spots. What these stories do to us financially can be both fascinating and terrifying. When I'm blind to parts of how the world works, I might completely misunderstand why the stock market is behaving like it is, in a way that gives me too much confidence in my ability to know what it might do next. Part of the reason forecasting the stock market and the economy is so hard is because you are the only person in the world who thinks the world operates the way you do. When you make decisions for reasons that I can't even comprehend, I might follow you blindly into a decision that's right for you and disastrous to me. This, as we saw in chapter 16, is how bubbles form. Coming to terms with how much you don't know means coming to terms with how much of what happens in the world is out of your control. And that can be hard to accept. Think about market forecasts. We're very, very bad at them. I once calculated that if you assume that the market goes up every year by its historic average, your accuracy is better than if you follow the average annual forecasts of the top 20 market strategists from large Wall Street banks. Our ability to predict recessions isn't much better. And since big events come out of nowhere, forecasts may do more harm than good, giving the illusion of predictability in a world where unforeseen events control most outcomes. Carl Richards writes, "Risk is what's left over when you think you've thought of everything." People know this. I have not met an investor who genuinely thinks market forecasts as a whole are accurate or useful. But there's still tremendous demand for forecasts in both the media and from financial advisors. Why? Psychologist Philip Tetlock once wrote, "We need to believe we live in a predictable, controllable world. So we turn to authoritative-sounding people who promise to satisfy that need." Satisfying that need is a great way to put it. Wanting to believe we are in control is an emotional itch that needs to be scratched, rather than an analytical problem to be calculated and solved. The illusion of control is more persuasive than the reality of uncertainty. So we cling to stories about outcomes being in our control. Part of this has to do with confusing fields of precision with fields of uncertainty. NASA's New Horizons spacecraft passed by Pluto 2 years ago. It was a 3 billion-mile trip that took 9.5 years. According to NASA, the trip took about 1 minute less than predicted when the craft was launched in January 2006. Think about that. In an untested, decade-long journey, NASA's forecast was 99.99998% accurate. That's like forecasting a trip from New York to Boston and being accurate to within 4 millionths of a second. But astrophysics is a field of precision. It isn't impacted by the vagaries of human behavior and emotions like finance is. Business, economics, and investing are fields of uncertainty, overwhelmingly driven by decisions that can't easily be explained with clean formulas like a trip to Pluto can. But we desperately want it to be like a trip to Pluto, because the idea of a NASA engineer being in 99.99998% control of an outcome is beautiful and comforting. It's so comforting that we're tempted to tell ourselves a story about how much control we have in other parts of our life, like money. Kahneman once laid out the path these stories take. When planning, we focus on what we want to do and can do, neglecting the plans and skills of others whose decisions might affect our outcomes. Both in explaining the past and in predicting the future, we focus on the casual role of skill and neglect the role of luck. We focus on what we know and neglect what we do not know, which makes us overly confident in our beliefs. He described how this impacts businesses. I have had several occasions to ask founders and participants in innovative startups a question. To what extent will the outcome of your effort depend on what you do in your firm? This is evidently an easy question. The answer comes quickly, and it has never been less than 80%. Even when they are not sure they will succeed, these bold people think their fate is almost entirely in their own hands. They are surely wrong. The outcome of a startup depends as much on the achievements of its competitors and on changes in the market as on its own efforts. However, entrepreneurs naturally focus on what they know best, their plans and actions, and the most immediate threats and opportunities, such as the availability of funding. They know less about their competitors and therefore find it natural to imagine a future in which competition plays little part. We all do this to some extent. And like my daughter, it doesn't bother us a bit. We don't wander around blind and confused. We have to think the world we operate in makes sense based on what we happen to know. It'd be too hard to get out of bed in the morning if you felt otherwise. But the alien circling over Earth, the one who's confident he knows what's happening based on what he sees, but turns out to be completely wrong because he can't know the stories going on inside everyone else's head, he's all of us. Chapter 19. All together now. Congratulations, you're still listening. It's time to tie together a few things we've learned. This chapter is a bit of a summary, a few short and actionable lessons that can help you make better financial decisions. First, let me tell you a story about a dentist appointment gone horribly awry. It teaches us something vital about the dangers of giving advice about what to do with your money. Clarence Hughes went to the dentist in 1931. His mouth was radiating pain. His dentist put him under crude anesthesia to ease the pain. When Clarence awoke hours later, he had 16 fewer teeth and his tonsils removed. And then everything went wrong. Clarence died a week later from his surgery's complications. His wife sued the dentist, but not because the surgery went awry. Every surgery risked death in 1931. Clarence, she said, never consented to the procedures in the first place, and wouldn't if he were asked. The case wove through courts, but went nowhere. Consent between doctor and patient wasn't black and white in 1931. One court summed up the idea that doctors require freedom to make the best medical decisions. Without such, we could not enjoy the advancement of science. For most of history, the ethos of medicine was that the doctor's job was to fix the patient, and what the patient thought about the doctor's treatment plans wasn't relevant. Dr. J. Katz wrote about the philosophy in his book, The Silent World Between Doctor and Patient. Doctors felt that in order to accomplish that objective, they were obligated to attend to the patient's physical and emotional needs, and to do so on their own authority, without consulting with their patients about the decisions that needed to be made. The idea that patients may also be entitled to sharing the burden of decisions with their doctors was never part of the ethos of medicine. This wasn't ego or malice. It was a belief in 2 points. 1, every patient wants to be cured. 2, there is a universal and right way to cure them. Not requiring patient consent in treatment plans makes sense if you believe in those 2 points. But that's not how medicine works. In the last 50 years, medical schools subtly shifted teaching away from treating disease and toward treating patients. That meant laying out the options of treatment plans and then letting the patient decide the best path forward. This trend was partly driven by patient protection laws, partly by Katz's influential book, which argued that patients have wildly different views about what's worth it in medicine, so their beliefs have to be taken into consideration. Katz wrote, "It is dangerous nonsense to assert that in the practice of their art and science, physicians can rely on their benevolent intentions, their abilities to judge what is the right thing to do. It is not that easy. Medicine is a complex profession, and the interactions between physicians and patients are also complex." That last line is important. Medicine is a complex profession, and the interactions between physicians and patients are also complex. You know what profession is the same? Financial advice. I can't tell you what to do with your money because I don't know you. I don't know what you want. I don't know when you want it. I don't know why you want it. So I'm not going to tell you what to do with your money. I don't want to treat you like a dentist treated Clarence Hughes. But doctors and dentists aren't useless, obviously. They have knowledge, they know the odds, they know what tends to work, even if patients come to different conclusions about what kind of treatment is right for them. Financial advisors are the same. There are universal truths in money, even if people come to different conclusions about how they want to apply those truths to their own finances. With that caveat in place, let's look at a few short recommendations that can help you make better decisions with your money. Go out of your way to find humility when things are going right, and forgiveness and compassion when they go wrong, because it's never as good or as bad as it looks. The world is big and complex. Luck and risk are both real and hard to identify. Do so when judging both yourself and others. Respect the power of luck and risk, and you'll have a better chance of focusing on things you can actually control. You'll also have a better chance of finding the right role models. Less ego, more wealth. Saving money is the gap between your ego and your income, and wealth is what you don't see. So wealth is created by suppressing what you could buy today in order to have more stuff or more options in the future. No matter how much you earn, you will never build wealth unless you can put a lid on how much fun you can have with your money right now, today. Manage your money in a way that helps you sleep at night. That's different from saying you should aim to earn the highest returns or save a specific percentage of your income. Some people won't sleep well unless they're earning the highest returns. Others will only get a good rest if they're conservatively invested. To each their own. But the foundation of, does this help me sleep at night, is the best universal guidepost for all financial decisions. If you want to do better as an investor, the single most powerful thing you can do is increase your time horizon. Time is the most powerful force in investing. It makes little things grow big and big mistakes fade away. It can't neutralize luck and risk, but it pushes results closer towards what people deserve. Become okay with a lot of things going wrong. You can be wrong half the time and still make a fortune, because a small minority of things account for the majority of outcomes. No matter what you're doing with your money, you should be comfortable with a lot of stuff not working. That's just how the world is. So you should always measure how you've done by looking at your full portfolio rather than individual investments. It is fine to have a large chunk of poor investments and a few outstanding ones. That's usually the best case scenario. Judging how you've done by focusing on individual investments makes winners look more brilliant than they were and losers more regrettable than they should. Use money to gain control over your time, because not having control of your time is such a powerful and universal drag on happiness. The ability to do what you want, when you want, with who you want, for as long as you want to, pays the highest dividend that exists in finance. Be nicer and less flashy. No one is impressed with your possessions as much as you are. You might think you want a fancy car or a nice watch, but what you probably want is respect and admiration. And you're more likely to gain those things through kindness and humility than horsepower and chrome. Save. Just save. You don't need a specific reason to save. It's great to save for a car or a down payment or a medical emergency, but saving for things that are impossible to predict or define is one of the best reasons to save. Everyone's life is a continuous chain of surprises. Savings that aren't earmarked for anything in particular is a hedge against life's inevitable ability to surprise the hell out of you at the worst possible moment. Define the cost of success and be ready to pay it, because nothing worthwhile is free. And remember that most financial costs don't have visible price tags. Uncertainty, doubt, and regret are common costs in the finance world. They're often worth paying, but you have to view them as fees, a price worth paying to get something nice in exchange, rather than fines, a penalty you should avoid. Worship room for error. A gap between what could happen in the future and what you need to happen in the future in order to do well is what gives you endurance. and endurance is what makes compounding magic over time. Room for error often looks like a conservative hedge, but if it keeps you in the game, it can pay for itself many times over. Avoid the extreme ends of financial decisions. Everyone's goals and desires will change over time, and the more extreme your past decisions were, the more you may regret them as you evolve. You should like risk because it pays off over time, but you should be paranoid of ruinous risk because it prevents you from taking future risks that will pay off over time. Define the game you're playing and make sure your actions are not being influenced by people playing a different game. Respect the mess. Smart, informed, and reasonable people can disagree in finance because people have vastly different goals and desires. There is no single right answer, just the answer that works for you. Now let me tell you what works for me. Chapter 20, Confessions. Sandy Gottsman, a billionaire investor who founded consulting group First Manhattan, is said to ask one question when interviewing candidates for his investment team. What do you own and why? Not what stocks do you think are cheap or what economy is about to have a recession. Just show me what you do with your own money. I love this question because it highlights what can often be a mile-wide gap between what makes sense, which is what people suggest you do, and what feels right to them, which is what they actually do. Half of all U.S. mutual fund portfolio managers do not invest a cent of their own money in their funds, according to Morningstar. This might seem atrocious, and surely the statistic uncovers some hypocrisy. But this kind of stuff is more common than you'd think. Ken Murray, a professor of medicine at USC, wrote an essay in 2011 titled "How Doctors Die" that showed the degree to which doctors choose different end-of-life treatment for themselves than they recommend for their patients. Doctors don't die like the rest of us, he wrote. What's unusual about them is not how much treatment they get compared to most Americans, but how little. For all the time they spend fending off the deaths of others, they tend to be fairly serene when faced with death themselves. They know exactly what is going to happen, they know the choices, and they generally have access to any sort of medical care they could want. But they go gently. A doctor may throw the kitchen sink at her patient's cancer, but choose palliative care for herself. The difference between what someone suggests you do and what they do for themselves isn't always a bad thing. It just underscores that when dealing with complicated and emotional issues that affect you and your family, there is no one right answer. There is no universal truth. There's only what works for you and your family, checking the boxes you want checked in a way that leaves you comfortable and sleeping well at night. There are basic principles that must be adhered to. This is true in finance and in medicine, but important financial decisions are not made in spreadsheets or in textbooks. They are made at the dinner table. They often aren't made with the intention of maximizing returns, but minimizing the chance of disappointing a spouse or child. Those kinds of things are difficult to summarize in charts or formulas, and they vary widely from person to person. What works for one person may not work for another. You have to find what works for you. Here's what works for me. How my family thinks about savings. Charlie Munger once said, "I did not intend to get rich, I just wanted to get independent." We can leave aside rich, but independence has always been my personal financial goal. Chasing the highest returns or leveraging my assets to live the most luxurious life has little interest to me. Both look like games people do to impress their friends, and both have hidden risks. I mostly just want to wake up every day knowing my family and I can do whatever we want to do on our terms. Every financial decision we make revolves around that goal. My parents lived their adult years in two stages, dirt poor and moderately well off. My father became a doctor when he was 40 and already had 3 kids. Earning a doctor's salary did not offset the frugal mentality that is forced when supporting 3 hungry kids while in medical school. And my parents spent the good years living well below their means with a high savings rate. This gave them a degree of independence. My father was an emergency room doctor, one of the highest stress professions I can imagine, and one that requires a painful toggling of circadian rhythms between night and day shifts. After 2 decades, he decided he'd had enough. So he stopped, just quit, moved on to the next phase of his life. That stuck with me. Being able to wake up one morning and change what you're doing on your terms, whenever you're ready, seems like the grandmother of all financial goals. Independence to me doesn't mean you'll stop working. It means you only do the work you like with people you like at the times you want for as long as you want. And achieving some level of independence does not rely on earning a doctor's income. It's mostly a matter of keeping your expectations in check and living below your means. Independence at any income level is driven by your savings rate. And past a certain level of income, your savings rate is driven by your ability to keep your lifestyle expectations from running away. My wife and I met in college and moved in with each other years before we got married. After school, we both had entry-level jobs with entry-level pay and settled into a moderate lifestyle. All lifestyles exist on a spectrum, and what is decent to one person can feel like royalty or poverty to another. But at our incomes, we got what we considered a decent apartment, a decent car, decent clothes, decent food. Comfortable, but nothing close to fancy. Despite more than a decade of rising incomes, myself in finance, my wife in healthcare, we've more or less stayed at that lifestyle ever since. That's pushed our savings rate continuously higher. Virtually every dollar of raise has accrued to savings, our independence fund. We now live considerably below our means, which tells you little about our income and more about our decision to maintain a lifestyle that we established in our 20s. If there's a part of our household financial plan I'm proud of, it's that we got the goalpost of lifestyle desires to stop moving at a young age. Our savings rate is fairly high, but we rarely feel like we're repressively frugal because our aspirations for more stuff haven't moved much. It's not that our aspirations are non-existent. We like nice stuff and live comfortably. We just got the goalpost to stop moving. This would not work for everyone, and it only works for us because we both agree to it equally. Neither of us are compromising for the other. Most of what we get pleasure from, going for walks, reading, podcasts, costs little, so we rarely feel like we're missing out. On the rare occasion when I question our savings rate, I think of the independence my parents earned from their years of high savings, and I quickly come back. Independence is our top goal. A secondary benefit of maintaining a lifestyle below what you can afford is avoiding the psychological treadmill of keeping up with the Joneses. Comfortably living below what you can afford without much desire for more removes a tremendous amount of social pressure that many people in the modern first world subject themselves to. Nassim Taleb explained, "True success is exiting some rat race to modulate one's activities for peace of mind." I like that. We're so far committed to the independence camp that we've done things that make little sense on paper. We own our house without a mortgage, which is the worst financial decision we've ever made, but the best money decision we've ever made. Mortgage interest rates were absurdly low when we bought our house. Any rational advisor would recommend taking advantage of cheap money and investing extra savings in higher return assets like stocks. But our goal isn't to be coldly rational, just psychologically reasonable. The independent feeling I get from owning our house outright far exceeds the known financial gain I'd get from leveraging our assets with a cheap mortgage. Eliminating the monthly payment feels better than maximizing the long-term value of our assets. It makes me feel independent. I don't try to defend this decision to those pointing out its flaws or those who would never do the same. On paper, it's defenseless, but it works for us. We like it. That's what matters. Good decisions aren't always rational. At some point, you have to choose between being happy or being right. We do keep a higher percentage of our assets in cash than most financial advisors would recommend. Something around 20% of our assets outside the value of our house. This is also close to indefensible on paper, and I'm not recommending it to others. It's just what works for us. We do it because cash is the oxygen of independence, and more importantly, we never want to be forced to sell the stocks we own. We want the probability of facing a huge expense and needing to liquidate stocks to cover it to be as close to zero as possible. Perhaps we just have a lower risk tolerance than others. But everything I've learned about personal finance tells me that everyone, without exception, will eventually face a huge expense they did not expect. And they don't plan for these expenses specifically because they did not expect them. The few people who know the details of our finances ask, "What are you saving for? A house, a boat, a new car?" No, none of those. I'm saving for a world where curveballs are more common than we expect. Not being forced to sell stocks to cover an expense also means we're increasing the odds of letting the stocks we own compound for the longest period of time. Charlie Munger put it well. The first rule of compounding is to never interrupt it unnecessarily. How my family thinks about investing. I started my career as a stock picker. At the time, we only owned individual stocks, mostly large companies like Berkshire Hathaway and Procter & Gamble, mixed with smaller stocks I considered deep value investments. Go back to my 20s, and at any given point, I held something like 25 individual stocks. I don't know how I did as a stock picker. Did I beat the market? I'm not sure. Like most who try, I didn't keep a good score. Either way, I've shifted my views, and now every stock we own is a low-cost index fund. I don't have anything against actively picking stocks, either on your own or through giving your money to an active fund manager. I think some people can outperform the market averages. It's just very hard, and harder than most people think. If I had to summarize my views on investing, it's this. Every investor should pick a strategy that has the highest odds of successfully meeting their goals. And I think for most investors, dollar cost averaging into a low-cost index fund will provide the highest odds of long-term success. That doesn't mean index investing will always work. It doesn't mean it's for everyone. And it doesn't mean active stock picking is doomed to fail. In general, this industry has become too entrenched on one side or the other, particularly those vehemently against active investing. Beating the market should be hard. The odds of success should be low. If they weren't, everyone would do it. And if everyone did it, there would be no opportunity. So no one should be surprised that the majority of those trying to beat the market fail to do so. I can afford to not be the greatest investor in the world, but I can't afford to be a bad one. When I think of it that way, the choice to buy the index and hold on is a no-brainer for us. I know not everyone will agree with that logic, especially my friends whose job it is to beat the market. I respect what they do, but this is what works for us. We invest money from every paycheck into these index funds, a combination of U.S. and international stocks. There's no set goal, it's just whatever is left over after we spend. We max out retirement accounts in the same funds and contribute to our kids' 529 college savings plans. And that's about it. Effectively, all of our net worth is a house, a checking account, and some Vanguard index funds. It doesn't need to be more complicated than that for us. I like it simple. One of my deeply held investing beliefs is that there is little correlation between investment effort and investment results. The reason is because the world is driven by tails. A few variables account for the majority of returns. No matter how hard you try at investing, you won't do well if you miss the 2 or 3 things that move the needle in your strategy. The reverse is true. Simple investment strategies can work great as long as they capture the few things that are important to that strategy's success. My investing strategy doesn't rely on picking the right sector or timing the next recession. It relies on a high savings rate, patience, and optimism that the global economy will create value over the next several decades. I spend virtually all of my investing effort thinking about those 3 things, especially the first 2, which I can control. I've changed my investment strategy in the past, so of course there's a chance I'll change it in the future. No matter how we save or invest, I'm sure we'll always have the goal of independence, and we'll always do whatever maximizes for sleeping well at night. We think it's the ultimate goal, the mastery of the psychology of money. But to each their own. No one is crazy. Postscript. A brief history of why the U.S. consumer thinks the way they do. To understand the psychology of the modern consumer and to grasp where they might be heading next, you have to know how they got here, how we all got here. If you fell asleep in 1945 and woke up in 2020, you would not recognize the world around you. The amount of economic growth that took place during that period is virtually unprecedented. If you saw the level of wealth in New York and San Francisco, you'd be shocked. If you compared it to the poverty of Detroit, you'd be shocked. If you saw the price of homes, college tuition, and healthcare, if you saw how average Americans think about savings and spending in general, you'd be shocked. And if you tried to think of a reasonable narrative of how it all happened, my guess is you'd be totally wrong. Because it isn't intuitive, and it wasn't foreseeable. What happened in America since the end of World War II is the story of the American consumer. It's a story that helps explain why people think about money the way they do today. The short story is this. Things were very uncertain, then they were very good, then pretty bad, then really good, then really bad, and now here we are. And there is, I think, a narrative that links all those events together. Not a detailed account, but a story of how things fit together. Since this is an attempt to link the big events together, it leaves out many details of what happened during this period. I'm likely to agree with anyone who points out what I've missed. The goal here is not to describe every play. It's to look at how one game influenced the next. Here's how the modern consumer got here. 1. August 1945, World War II ends. Japan surrendering was the happiest day in American history, the New York Times wrote. But there's the saying, history is just one damn thing after another. The joy of the war ending was quickly met with the question, what happens now? 16 million Americans, 11% of the population, served in the war. About 8 million were overseas at the end. Their average age was 23. Within 18 months, all but 1.5 million of them would be home and out of uniform. And then what? What were they going to do next? Where were they going to work? Where were they going to live? Those were the most important questions of the day for two reasons. One, no one knew the answers. Two, if they couldn't be answered quickly, the most likely scenario in the eyes of many economists was that the economy would slip back into the depths of the Great Depression. Three forces had built up during the war. One, housing construction ground to a halt, as virtually all production capacity was shifted to building war supplies. Fewer than 12,000 homes per month were built in 1943, equivalent to less than one new home per American city. Returning soldiers faced a severe housing shortage. Two, the specific jobs created during the war, building ships, tanks, and planes, were very suddenly not necessary after it, stopping with a speed and magnitude rarely seen in private business. It was unclear where soldiers could work. 3. The marriage rate spiked during and immediately after the war. Soldiers didn't want to return to their mother's basement. They wanted to start a family in their own home with a good job right away. This worried policymakers, especially since the Great Depression was still a recent memory, having ended just 5 years prior. In 1946, the Council of Economic Advisers delivered a report to President Truman, warning of a full-scale depression sometime in the next 1 to 4 years. They wrote in a separate 1947 memo summarizing a meeting with Truman. We might be in some sort of recession period where we should have to be very sure of our ground as to whether recessionary forces might be in danger of getting out of hand. There is a substantial prospect, which should not be overlooked, that a further decline may increase the danger of a downward spiral into depression conditions. This fear was exacerbated by the fact that exports couldn't be immediately relied upon for growth. as two of the largest economies, Europe and Japan, sat in ruins dealing with humanitarian crises. And America itself was buried in more debt than ever before, limiting direct government stimulus. So we did something about it. 2. Low interest rates and the intentional birth of the American consumer. The first thing we did to keep the economy afloat after the war was keep interest rates low. This wasn't an easy decision, because when soldiers came home to a shortage of everything from clothes to cars, it temporarily sent inflation into double digits. The Federal Reserve was not politically independent before 1951. The president and the Fed could coordinate policy. In 1942, the Fed announced it would keep short-term rates at 0.38% to help finance the war. Rates didn't budge a single basis point for the next 7 years. 3-month Treasury yields stayed below 2% until the mid-1950s. The explicit reason for keeping rates down was to keep the cost of financing the equivalent of the $6 trillion we spent on the war low. But low rates also did something else for all the returning GIs. It made borrowing to buy homes, cars, gadgets, and toys really cheap, which, from a paranoid policymaker's perspective, was great. Consumption became an explicit economic strategy in the years after World War II. An era of encouraging thrift and saving to fund the war quickly turned into an era of actively promoting spending. Princeton historian Sheldon Garin writes, "After 1945, America again diverged from patterns of savings promotion in Europe and East Asia. Politicians, businessmen, and labor leaders all encouraged Americans to spend to foster economic growth." 2 things fueled this push. One was the GI Bill, which offered unprecedented mortgage opportunities. 16 million veterans could buy a home, often with no money down, no interest in the first year, and fixed rates so low that monthly mortgage payments could be lower than a rental. The second was an explosion of consumer debt, enabled by the loosening of Depression-era regulations. The first credit card was introduced in 1950. Store credit, installment credit, personal loans, payday loans, everything took off. And interest on all debt, including credit cards, was tax deductible at the time. It tasted delicious, so we ate a lot of it. A simple story in a simple table. In 1945, total U.S. household debt was $29.4 billion. 1955, it was $125.7 billion. In 1965, total U.S. household debt was $331.2 billion. Household debt in the 1950s grew 1.5 times faster than it did during the 2000s debt splurge. 3. Pent-up demand for stuff, fed by a credit boom and a hidden 1930s productivity boom, led to an economic boom. The 1930s were the hardest economic decade in American history, but there was a silver lining that took 2 decades to notice. By necessity, the Great Depression had supercharged resourcefulness, productivity, and innovation. We didn't pay that much attention to the productivity boom in the 30s because everyone was focused on how bad the economy was. We didn't pay attention to it in the 40s because everyone was focused on the war. Then we suddenly realized, wow, we have some amazing new inventions, and we're really good at making them. Appliances, cars, phones, air conditioning, electricity. It was nearly impossible to buy many household goods during the war because factories were converted to make guns and ships. That created pent-up demand from GIs for stuff after the war ended. Married, eager to get on with life, and emboldened with new cheap consumer debt, they went on a buying spree like the country had never seen. Frederick Lewis Allen writes in his book, The Big Change, "During these post-war years, the farmer bought a new tractor, a corn picker, an electric milking machine. In fact, he and his neighbors, between them, assembled a formidable array of farm machinery for their joint use. The farmer's wife got the shining white electric refrigerator she had always longed for and never during the Great Depression had been able to afford, and an up-to-date washing machine and a deep freeze unit. The suburban family installed a dishwashing machine and invested in a power lawnmower. The city family became customers of a laundromat and acquired a television set for the living room. The husband's office was air-conditioned, and so on endlessly. It's hard to overstate how big this surge was. Commercial car and truck manufacturing virtually ceased from 1942 to 1945. Then, 21 million cars were sold from 1945 to 1949. Another 37 million were sold by 1955. Just under 2 million homes were built from 1940 to 1945. Then 7 million were built from 1945 to 1950. Another 8 million were built by 1955. Pent-up demand for stuff and our newfound ability to make stuff created the jobs that put returning GIs back to work. And they were good jobs, too. Mix that with consumer credit, and America's capacity for spending exploded. The Federal Reserve wrote to President Truman in 1951, by 1950, total consumer expenditures, together with residential construction, amounted to about $203 billion, or in the neighborhood of 40% above the 1944 level. The answer to the question, what are all these GIs going to do after the war, was now obvious. They were going to buy stuff with money earned from their jobs making new stuff, helped by cheap borrowed money to buy even more stuff. 4. Gains are shared more equally than ever before. The defining characteristic of economics in the 1950s is that the country got rich by making the poor less poor. Average wages doubled from 1940 to 1948, then doubled again by 1963. And those gains focused on those who had been left behind for decades before. The gap between rich and poor narrowed by an extraordinary amount. Lewis Allen wrote in 1955, "The enormous lead of the well-to-do in the economic race has been considerably reduced. It is the industrial workers who, as a group, have done best. People such as a steelworkers family, who used to live on $2,500 and now are getting $4,500, or the highly skilled machine tool operators family, who used to have $3,000 and now can spend an annual $5,500 or more. The top 1%, the really well-to-do and the rich, whom we might classify very roughly indeed as the 16,000 and over group, their share of the total national income after taxes had come down by 1945 from 13% to 7%. This was not a short-term trend. Real income for the bottom 20% of wage earners grew by a nearly identical amount as the top 5% from 1950 to 1980. The equality went beyond wages. Women held jobs outside the home in record numbers. Their labor force participation rate went from 31% after the war to 37% by 1955 and to 40% by 1965. Minorities gained too. After the 1945 inauguration, Eleanor Roosevelt wrote about an African-American reporter who told her, "Do you realize what 12 years have done? If at the 1933 reception, a number of colored people had gone down the line and mixed with everyone else in the way they did today, every paper in the country would have reported it. We do not even think it is news, and none of us will mention it." Women and minority rights were still a fraction of what they are today, but the progress toward equality in the late 40s and 50s was extraordinary. The leveling out of classes meant a leveling out of lifestyles. Normal people drove Chevys. Rich people drove Cadillacs. TV and radio equalized the entertainment and culture people enjoyed, regardless of class. Mail-order catalogs equalized the clothes people wore and the goods they bought, regardless of where they lived. Harper's Magazine noted in 1957, "The rich man smokes the same sort of cigarettes as the poor man, shaves with the same sort of razor, uses the same sort of telephone, vacuum cleaner, radio, and TV set, has the same sort of lighting and heating equipment in his house, and so on indefinitely. The differences between his automobile and the poor man's are minor. Essentially, they have similar engines, similar fittings. In the early years of the century, there was a hierarchy of automobiles. Paul Graham wrote in 2016 about what something as simple as there only being 3 TV stations did to equalize culture. It's difficult to imagine now, but every night, tens of millions of families would sit down together in front of their TV set, watching the same show at the same time as their next-door neighbors. Super Bowl used to happen every night. We were literally in sync. This was important. People measure their well-being against their peers. And for most of the 1945 to 1980 period, people had a lot of what looked like peers to compare themselves to. Many people, most people, lived lives that were either equal or at least fathomable to those around them. The idea that people's lives equalized as much as their incomes is an important point of this story we'll come back to. 5. Debt rose tremendously, but so did incomes, so the impact wasn't a big deal. Household debt increased fivefold from 1947 to 1957 due to the combination of the new consumption culture, new debt products, and interest rates subsidized by government programs and held low by the Federal Reserve. But income growth was so strong during this period that the impact on households wasn't severe, and household debt was so low to begin with after the war. The Great Depression wiped out a lot of it, and household spending was so curtailed during the war that debt accumulation was restricted. So the growth in household debt to income from 1947 to 1957 was manageable. Household debt to income today is just over 100%. Even after rising in the 1950s, 1960s, and 1970s, it stayed below 60%. Driving a lot of this debt boom was a surge in home ownership. The home ownership rate in 1900 was 47%. It stayed right about there for the next 4 decades. Then it took off, hitting 53% by 1945 and 62% by 1970. A substantial portion of the population was now using debt that previous generations could not have accessed. And they were mostly okay with it. David Halberstam writes in his book, The 50s, they were confident in themselves and their futures in a way that those growing up in harder times found striking. They did not fear debt as their parents had. They differed from their parents, not just in how much they made and what they owned, but in their belief that the future had already arrived. As the first homeowners in their families, they brought a new excitement and pride with them to the store as they bought furniture or appliances. In other times, young couples might have exhibited such feelings as they bought clothes for their first baby. It was as if the very accomplishment of owning a home reflected such an immense breakthrough that nothing was too good to buy for it. Now's a good time to connect a few things, as they'll become increasingly important. America is booming. It's booming together like never before. It's booming with debt that isn't a big deal at the time because it's still low relative to income. And there's a cultural acceptance that debt isn't a scary thing. 6. Things start cracking. 1973 was the first year where it became clear the economy was walking down a new path. The recession that began that year brought unemployment to the highest it had been since the 1930s. Inflation surged, but unlike the post-war spikes, it stayed high. Short-term interest rates hit 8% in 1973, up from 2.5% a decade earlier. And you have to put all of that in the context of how much fear there was between Vietnam, riots, and the assassinations of Martin Luther King and John and Bobby Kennedy. It got bleak. America dominated the world economy in the 2 decades after the war. Many of the largest countries had their manufacturing capacity bombed into rubble. But as the 1970s emerged, that changed. Japan was booming. China's economy was opening up. The Middle East was flexing its oil muscles. A combination of lucky economic advantages and a culture shared by the greatest generation, hardened by the Depression and anchored in systematic cooperation from the war, shifted when baby boomers began coming of age. A new generation that had a different view of what's normal hit at the same time a lot of the economic tailwinds of the previous 2 decades ended. Everything in finance is data within the context of expectations. One of the biggest shifts of the last century happened when the economic winds began blowing in a different, uneven direction, but people's expectations were still rooted in a post-war culture of equality. Not necessarily equality of income, although there was that, but equality in lifestyle and consumption expectations. The idea that somebody earning a 50th percentile income shouldn't live a life dramatically different than someone in the 80th or 90th percentile, and that someone in the 99th percentile lived a better life, but still a life that someone in the 50th percentile could comprehend. That's how America worked for most of the 1945 to 1980 period. It doesn't matter whether you think that's morally right or wrong. It just matters that it happened. Expectations always move slower than facts, and the economic facts of the years between the early 1970s through the early 2000s were that growth continued but became more uneven, yet people's expectations of how their lifestyle should compare to their peers did not change. 7. The boom resumes, but it's different than before. Ronald Reagan's 1984 Morning in America ad declared, "It's morning again in America. Today, more men and women will go to work than ever before in our country's history. With interest rates at about half the record highs of 1980, nearly 2,000 families today will buy new homes, more than at any time in the past 4 years. This afternoon, 6,500 young men and women will be married. And with inflation at less than half of what it was just 4 years ago, they can look forward with confidence to the future." That wasn't hyperbole. GDP growth was the highest it had been since the 1950s. By 1989, there were 7 million fewer unemployed Americans than there were 7 years before. The S&P 500 rose almost fourfold between 1982 and 1990. Total real GDP growth in the 1990s was roughly equal to that of the 1950s, 40% versus 42%. Incomes rise 18% over the past decade. Those in the middle have actually seen their incomes fall. For men with only high school degrees, the decline has been precipitous, 12% in the last quarter century alone. It was nearly the opposite of the flattening that occurred after the war. Why this happened is one of the nastiest debates in economics, topped only by the debate over what we should do about it. Lucky for the purpose of this discussion, neither matters. All that matters is that sharp inequality became a force over the last 35 years, and it happened during a period where, culturally, Americans held on to 2 ideas rooted in the post-World War II economy: that you should live a lifestyle similar to most other Americans, and that taking on debt to finance that lifestyle is acceptable. 8. The big stretch. Rising incomes among a small group of Americans led to that group breaking away in lifestyle. They bought bigger homes, nicer cars, went to expensive schools, and took fancy vacations. And everyone else was watching, fueled by Madison Avenue in the 80s and 90s, and the internet after that. The lifestyles of a small portion of legitimately rich Americans inflated the aspirations of the majority of Americans, whose incomes weren't rising. A culture of equality and togetherness that came out of the 1950s, 60s, and 70s innocently morphs into a keeping up with the Joneses effect. Now you can see the problem. Joe, an investment banker making $900,000 a year, buys a 4,000 square foot house with 2 Mercedes and sends 3 of his kids to Pepperdine. He can afford it. Peter, a bank branch manager making $80,000 a year, sees Joe and feels a subconscious sense of entitlement to live a similar lifestyle, because Peter's parents believed and instilled in him that Americans' lifestyles weren't that different, even if they had different jobs. His parents were right during their era, because incomes fell into a tight distribution. But that was then. Peter lives in a different world, but his expectations haven't changed much from his parents, even if the facts have. So what does Peter do? He takes out a huge mortgage. He has $45,000 of credit card debt. He leases 2 cars. His kids will graduate with heavy student loans. He can't afford the stuff Joe can, but he's pushed to stretch for the same lifestyle. It is a big stretch. This would have seemed preposterous to someone in the 1930s. But we've spent 75 years since the end of the war fostering a cultural acceptance of household debt. During a time when median wages were flat, the median new American home grew 50% larger. The average new American home now has more bathrooms than occupants. Nearly half have 4 or more bedrooms, up from 18% in 1983. The average car loan, adjusted for inflation, more than doubled between 1975 and 2003, from $12,300 to $27,900. And you know what happened to college costs and student loans. Household debt to income stayed about flat from 1963 to 1973. Then it climbed and climbed and climbed from around 60% in 1973 to more than 130% by 2007. Even as interest rates plunged from the early 1980s through 2020, the percentage of income going to debt service payments rose, and it skewed toward lower income groups. The share of income going toward debt and lease payments is just over 8% for the highest income groups, those with the biggest income gains, but over 21% for those below the 50th percentile. The difference between this climbing debt and the debt increase that took place during the 1950s and 60s is that the recent jump started from a high base. Economist Hyman Minsky described the beginning of debt crises, the moment when people take on more debt than they can service. It's an ugly, painful moment. It's like Wile E. Coyote looking down, realizing he's screwed, and falling precipitously, which of course is what happened in 2008. 9. Once a paradigm is in place, it is very hard to turn it around. A lot of debt was shed after 2008, and then interest rates plunged. Household debt payments as a percentage of income are now at their lowest level in 35 years. But the response to 2008, necessary as it may have been, perpetuated some of the trends that got us here. Quantitative easing both prevented economic collapse and boosted asset prices, a boon for those who owned them, mostly rich people. The Fed backstopped corporate debt in 2008. That helped those who owned the debt, mostly rich people. Tax cuts over the last 20 years have predominantly gone to those with higher incomes. People with higher incomes send their kids to the best colleges. Those kids can go on to earn higher incomes and invest in corporate debt that will be backstopped by the Fed, own stocks that will be supported by various government policies, and so on. None of these things are problems in and of themselves, which is why they stay in place. But they're symptomatic of the bigger thing that's happened since the early 1980s. The economy works better for some people than others. Success isn't as meritocratic as it used to be, and when success is granted, it's rewarded with higher gains than in previous eras. You don't have to think that's morally right or wrong. And again, in this story, it doesn't matter why it happened. It just matters that it did happen. It just matters that it did happen. And it caused the economy to shift away from people's expectations that were set after the war. That there's a broad middle class without systematic inequality where your neighbors live next door and a few miles down the road live a life that's pretty similar to yours. Part of the reason these expectations have stuck around for 35 years after they shifted away from reality is because they felt so good for so many people when they were valid. Something that good, or at least the impression that it was that good, isn't easy to let go of. So people haven't let go of it, and they want it back. 10. The Tea Party, Occupy Wall Street, Brexit, and Donald Trump each represents a group shouting, "Stop the ride, I want off." The details of their shouting are different, but they're all shouting, at least in part, because stuff isn't working for them within the context of the post-war expectation that stuff should work roughly the same for roughly everyone. You can scoff at linking the rise of Trump to income inequality alone, and you should. These things are always layers of complexity deep. But it's a key part of what drives people to think, I don't live in the world I expected. That pisses me off. So screw this and screw you. I'm going to fight for something totally different because this, whatever it is, isn't working. Take that mentality and raise it to the power of Facebook, Instagram, and cable news, where people are more keenly aware of how other people live than ever before. It's gasoline on a flame. Benedict Evans says, the more the internet exposes people to new points of view, the angrier people get that different views exist. There's a big shift from the post-war economy where the range of economic opinions were smaller, both because the actual range of outcomes was smaller, and because it wasn't as easy to see and learn what other people thought and how they lived. I'm not pessimistic. Economics is the story of cycles. Things come, things go. The unemployment rate is now the lowest it's been in decades. Wages are now actually growing faster for low-income workers than the rich. College costs, by and large, stop growing once grants are factored in. If everyone studied advances in healthcare, communication, transportation, and civil rights since the glorious 1950s, my guess is most wouldn't want to go back. But a central theme of this story is that expectations move slower than reality on the ground. That was true when people clung to 1950s expectations as the economy changed over the next 35 years. And even if a middle-class boom began today, expectations that the odds are stacked against everyone but those at the top may stick around. So the era of "this isn't working" may stick around. And the era of "we need something radically new right now, whatever it is," may stick around. Which, in a way, is part of what starts events that led to things like World War II, where this story began. History is just one damn thing after another. This has been The Psychology of Money, Timeless Lessons on Wealth, Greed, and Happiness by Morgan Housel. Thank you for listening.
Audible hopes you have enjoyed this program.